Welcome to another video. The topic for today's discussion is financial accounts of a sole trader. So in this video we are going to discuss about some of the introduction part of concept of accounting and what are the different accounting statement that is prepared by a sole trader at the end of his particular financial year or accounting year time period. As you know, the concept of accounting is a very old origin, since there will be the situation of a barter transaction, and after that there will be the concept of double entry system of bookkeeping that emerged in 1494. The modern system of accounting has developed by Luca Pacioli. He's an Italian who developed the concept of the modern system of accounting. The modern system of accounting is otherwise called, it is a language of a business concern. It is the process of communicating the result to the interested parties or outsiders, well-wishers, government, etc. As you know, the object of every business concern is to make profit. So when the volume of business is enhanced, there will be large number of transactions will be there. In that time, there will be the system of accounting is necessary. Account is a statement of transactions during a fiscal period and the resulting balance. It is a transaction during a fiscal time period. Normally there will be a time period, maybe if it is a financial year, 1st April to 31st March. If it is an annual system, 1st January to 31st December. So there will be a time period. So that is called duration. It is an oral or written description. So you are presenting the things in orally or in the written form of description of particular event or situation. There will be an event or a situation will be there. You are presenting that contents in oral, the outcome content in oral or written description form. And in addition to that, it is a record. It is a statement of record, and the statement of a record of a financial expenditure and receipt. You have two things are there. One is the part of expenditure and another one is a part of receipt. So both these things will be included in this particular statement that is called account. And that expenditure and incomes, as we discussed, it is prepared based on the facts and figures for a particular period of time. So once you are preparing the account, there will be a definite purpose, there will be a definite objective of preparing a particular statement of account. Accounts can be classified into some categories, and the first one, three main categories are there, and the first one is the personal account, and the accounts that are related with individuals, companies, firms, group of associations, etc. are called personal accounts. So normally if you are going through textbooks, it is the accounts related to natural or artificial persons, that is called a personal account. So in this, the account of individual will be there, artificial person called company is there, and firm, partnership firm is there, association of person is there, body of individual is there. So that is called a personal account. And here the personal accounts can be classified into three main categories, and these are the three important types of personal account. And the first one is called a natural personal account, second one is called a artificial personal account, and third one is called a representative personal account. I will tell you what is a natural personal account. These are the accounts related to natural persons. So there will be a natural person or an individual. So the account of a particular person, Mr. V have a particular account. V's account is a natural personal account. Mr. A is a natural person and A's account is a natural personal account. Mr. K is a natural person and K's account is a natural personal account. Let us see, the second one is artificial personal account. So these are the accounts that is related to the companies and institutions. Maybe companies or an institution, they have an account. That account is called an artificial personal account. And account of K Limited, account of B Limited, account of Apollo Tires, account of MRF. So these are the companies that they have formed. So the account of a particular company comes in artificial personal account. The companies and institutions are the entities. So that is they have a, that is as per the Companies Act itself, they have a legal personality, they have a perpetual succession, and they have a common seal that is called the signature of the company. The common seal is called the signature of the companies. So they are considered, the companies or institutions are considered as an artificial person. So that is why the account is called an artificial personal account. Then the third one is a representative personal account. So maybe there will be a particular account that will be representing, it is a representative of a group of person, that is called a representative personal account. There will be an account that will be creating for a group of person or a group of individual is called a representative personal account. And some of the accounts like outstanding interest account, outstanding wages account, prepaid expense account. So these are some of the examples of a representative personal account. So there will be an account, and that account will be representing a group of individual or a group of people. So that is called a representative personal account. Let us see what is real accounts. So the second category of account is a real account, and that is related with the properties, assets or possessions. So an account related to the properties, asset or possessions are called the real account. And these properties can be both physical existing as well as non-physical in nature. No, there will be natural or artificial things are there. That means there are certain things that you can see or touch. There are certain invisible asset or things will be there. That is also the part of this real account. And here the real account can be classified into what we have discussed right now on the basis of their identity, that is called a tangibility and intangibility. If an account is preparing for that is which we have a physical existence, so that is called a tangible real account. So that in case that you can see or touch or you can measure, etc., is possible. So that is called a tangible real account. And in other ways, such asset can be seen, felt or touched. So we can see the assets like building or furniture or machinery, etc., that we can see or touch or measure. So that is called a tangible real account. So here we can see that the example of machinery, vehicle, building, etc., these are the tangible real assets. So the accounts of such asset is called a tangible real account. And the second one is the account of intangible assets. Intangible assets that we can't see the asset. There is no physical existence of that particular asset, but we have to measure that one in terms of money. There will be a monetary measurement or a monetary valuation will be there for that particular asset, but there is no physical existence. So that asset is called intangible assets. And the assets of that case, we are preparing an account that is called intangible real account. See some of the examples like trademark, patent, goodwill, copyright, etc. These are some of the intangible real assets. So if we are preparing an account for intangible assets, so that is called an intangible real account. And the third category of account is nominal account, and it's account related to income, expense, loss, gain. So it's an account related to income, expense, loss, gain, etc. And the examples are wages, salary account, rent account. These are the examples of a nominal account. So these are the three types of accounts: personal account, real account, and nominal account. Personal account we can classify into three categories: natural personal account, artificial personal account, and representative personal account. Real account we can classify into two categories: tangible real account and intangible real account. And next we are going to discuss about the golden rules related to accounts. The golden rule of accounting is also revolved around the debit and credit. It is based on the two sides of an account, that is called a debit side and a credit side, and based on which three main rules are there in accounting. And the first one is debit the receiver and credit the giver. This is the first rule. Second one, debit what comes in and credit what goes out. That is the second rule. And the third one, debit expense and loss, credit incomes and gains. So these are the three golden rules of accounting based on the debit and credit side of an account. So left hand side of an account is called a debit side, and right hand side of an account is called a credit side. So what are the items that is there in the debit side? That is called debit receiver and credit giver. Debit what comes in and credit what goes out. Debit expense and losses and credit incomes and gains. These are the golden rules of accounts. Let us see what is accounting. Accounting is the system of recording and summarizing business and financial transactions and analyzing, verifying and reporting the results. So it is a process, it is a system of recording, summarizing the business and financial transactions. You are going to record something, you are going to summarize summarize a business and financial transactions. You are verifying and analyzing the transactions, then you are reporting to the interested party. So here in all these things are there in cases of accounting. Accounting, the major process are recording is the first one, then summarizing is the next one, and evaluating the financial transactions and analyzing the financial transactions, verifying the result and reporting to the interested parties. So these are all the things that the process or things that will be there in cases of accounting. And here we summarizing, analyzing and reporting the transactions. The object of such process is to giving information towards the interested parties like agencies, regulators, tax collection, that is income tax authorities and all. We are giving information about that particular transaction of a time period. It is a summary of financial transactions over an accounting period and summarizing the company's operations, financial positions and cash flows. It summarizes the company's financial operations. So what will be the financial position of the companies and analyzing the cash flows, that is the inflow of cash and the outflow of cash situation. Let us see what is journal and ledger. A journal is a chronological record of business transactions. So it will be a chronologically, when there will be a transaction is there, you are chronologically record the transactions, that is called in a book, that is called journal, and it is entering the transactions in a journal, that is called journal entry, is the recording of business transactions in the journal. So journal entry is the recording of a business transaction in the journal. So in a journal entry, it shows all the effect of business transaction expressed in debit and credit, and may include the explanation of the transaction. So once you are entering the transaction, you are entering the values in both the side, that is debit side and credit side, and at the same time it explaining what will be the content of that transaction. So that is called narration. You are briefing the that is the things that is happen in a particular situation. That is also there in cases of a journal. And in ledger, a ledger is a complete collection of accounts and transactions of a company. It is a complete collection of accounts. Lot of accounts are there that will be there in a company, and it is a collection of all that account, that is called ledger. And the ledger may be in loosely form in a bound volume or in a computer memory. So you can enter that things in a ledger in any of the form. You can prepare in loose leaf form, you can prepare in a book, or you can enter in a computer system. So whatever it is your choice of your organization, you can do. The process of recording transaction from journal to ledger is called posting. So this is a process of recording a transaction from journal to ledger, that is called posting. And after that, you are preparing a statement that is called a trial balance. It is the statement that is preparing to check the arithmetical accuracy of a transaction. You have to measure the arithmetical accuracy of a transaction. You are preparing a statement, so that is called a trial balance. And here it is a statement that is exhibit the total of debit and credit balance recorded in various ledgers. So you are taking the balancing figure from the ledger, and from the balance that you are taken from different heads from the ledger, you are preparing a summarized statement. So that is called a trial balance. And here it is prepared to check the accuracy of various transactions that are posted in ledger accounts also. So once you are posted in ledger account, so you are putting the transaction in trial balance, how much it is accurate, that also you are measuring that particular situation. It is certainly one of the important accounting tools, as it reveals the final position of all the accounts. It is an important thing because it reveals the final position of all the accounts. That is why it is the most important thing. And it is used in preparing the final accounting statement of the business. It is used to preparing the final accounting statement of the business. Then final accounts is the next topic, and final accounts can be referred to as the final preparing from the final trial balance or the final statement up upon which they are based. So there will be a basis for preparing the final account. It is preparing on the basis of the values that is given in the trial balance. The primary financial statements are the income statement, balance sheet, and statement of cash flows. So income statements is the statement, balance sheet is the another statement, and the cash flow statement is to measure the cash inflow and the cash outflow. A final account or a final accounting can also be summarized statement issued when a business transactions has been concluded. So final accounting will be a summarizing process when there will be a business transaction has concluded. That transaction has to be summarized by the help of a final account. So final accounts of a business are prepared after trial balance. As we discussed, we are preparing the trial balance based on the values, facts and figures in the trial balance. You are going to prepare the final account. So it is preparing after the trial balance, and it includes trading account, profit and loss account, and balance sheet. These are the three accounts in final account, that is a trading account, profit loss account, and balance sheet. And in trading account and profit loss account, we call it as income statement, and balance sheet is call it as the position statement. So in trading account, we are preparing the trading account by the entities to know the profit earned or loss suffered from trading activities. What will be the profit that earned by a concern, or what will be the loss that suffered by the firm from the trading activities. In order to measure or in order to ascertain that one, you are going to prepare the trading account. It indicate the result of trading activities such as purchase and sale of products. You are purchasing something for the trading activities that will be there on the purchase side or on the debit side, and sales or sales related activities are there on the credit side of that particular account. It is prepared to ascertaining the gross profit for a particular period of time, and the balance of this account is transferred to profit and loss account, and it is an account for a direct revenue and direct expenses. It is an account for direct revenue and direct expenses, having two sides, and debit side indicate the expenses, and credit side of that account indicates the direct incomes. So debit side indicate the direct expenses, and the credit side shows the direct income. So this is the nature of a trading account. Direct expenses which are incurred by the organization to bring goods into the condition or fit for sale. So there are some expenses that is incurred for bringing the goods into condition. So that for an organization, you are taking some goods for your production process, you are taking some raw materials for your production process, there are some sort of expenses incurred. So that is called direct expenses. And there are some expenses like fuel, power, freight, insurance, carriage, consumption of stores, etc. These are all some of the direct expenses part. And direct incomes refers to the incomes from the activities that are earned from the sale of goods. Once there will be a sale situation, there will be some sort of income that you are getting from the activity of sale. So that is called a direct income. See, this is the format of a trading account. Here two sides are there, debit side and credit side. And debit side, opening stock, purchases, less return outwards or purchase return, then wages, carriage inwards, freight inwards or cartage, then gross profit is the balancing figure. Then the credit side, sales less sales return or return inwards, then stock at the end of the period, that is called a closing stock. Then after that there will be either gross profit or gross loss situation. If there is gross loss, debit balance is higher, there will be a situation of gross loss. So gross loss will be there transferred to profit and loss account. If the amount of gross profit or gross loss, whatever it is, that has to transfer to the next account, that is called a profit and loss account. It is an account that is created to ascertaining the net profit or loss for the period. So it is a profit loss account is an account that is created to ascertain the net profit or loss for the period. You are ascertaining the net profit or net loss for the period. It is a statement that is a financial statement that summarizes the revenue, cost and expenses incurred during a specified period. It summarizes the revenues, it summarizes the cost factor, it summarizes the expense situations incurred during a specific period of time. And P&L account statement is one of the financial statement every public company issue quarterly or annually along with the balance sheet and the cash flow statement. So it is a statement that is prepared by a sole trader or a company, whatever it is preparing a particular maybe it can issues quarterly or annually along with the balance sheet or along with the balance sheet, whatever it is, and measuring the cash flow statement also during that particular time period. And it is a part of the financial statement which takes into account the operating and non-operating revenues. It is a part of the financial statement that takes into account the operating and non-operating revenues and expenses incurred during an accounting period. It ascertains net profit earned or loss sustained by the business. So this is the format of profit and loss account. Expenses will be on the debit side and income will be on the, there will be some receipt will be on the credit side, and like salary paid, office rent, printing and stationery, telephone expenses, postage and telegram, discount allowed, insurance, audit fee, electricity charges, repairs, etc., etc. So depreciation, etc. Some of the items are the expenses, that is on the debit side. Discount received, commission received, bank interest, rent received, all the receipts will be on the credit side. See, on top of that there will be a gross loss brought down and a gross profit brought down. Gross loss brought down, that has been taken from the credit side of your trading account, and a gross profit brought down is from the debit side of your trading account. Either gross profit or a gross loss will be there, and the balance of this particular account is called a net profit. And will be the last one, net profit, that will be transferring to your balance sheet. Net profit amount, that you are transferring the amount of net profit to balance sheet. See, what is balance sheet? Balance sheet is the one of the fundamental financial statement, both for financial modeling and accounting. It will be supporting for evaluating assessing the financial position. It will supporting for financial modeling. It displays the company's total assets, how the assets are financed through either debt or equity. So it helps to measure what will be the situation of financial position of a particular company, what will be the debt position of a company, what will be the total equity of a company. It will helps to measure the debt as well as the equity position of the company. It is also referred to as a statement of net worth or a statement of financial position. It is a statement of net worth or a statement of a financial position. You are measuring the statement of net worth. You are measuring the statement of a financial position of a company. So based on which you are formulating an equation. So this is an equation of accounting equation, and balance sheet is based on the fundamental equation asset is equal to liabilities plus equity. Asset is equal to liabilities plus equity is the fundamental equation of fundamental accounting equation. Balance sheet is divided into two sides or sections, and a left side there will be left side there will be liabilities, and right side there will be assets. So you are preparing a balance sheet, two sides are there, liabilities and asset. And in each side the main line of items can be classified into different groups, like liquid things will be there, like inventory, cash, trade payables, etc. are liquid accounts, and another things like plant, property, equipments, etc. are the long term debts. So and long-term debts, etc. are there. So different types or different category of items are there, and assets and liabilities are separated into two categories: current assets and liabilities, and non-current assets and liabilities. There will be current assets and current liabilities, non-current assets and non-current liabilities will be there. So in asset section, all the resources, assets of a business are listed. In asset section, all the resources of the business are listed. In balance sheet, assets having a similar characteristics are grouped together. You are grouping the assets together, and asset here we divide into two categories: current assets and non-current assets. Current assets include cash, and all the assets that can be converted into cash are expected to be consumed within a short span of time. So cash or cash equivalent items that will be comes in current asset category. That is, cash equivalent means there are some assets that you can convert it into cash within a short span of time. That is called that will be also the part of current assets. Here cash equivalents like accounts receivable, prepaid expenses, advance payment, short-term investment, inventories or stocks, etc. All these are the part of current assets. And such assets include long-term investment, equipment, plant, machinery, etc. These are all the second category of assets. So these assets which is not listed in current asset, that is called non-current assets, and these are some of the examples of non-current assets like plant, machinery, land, building, etc. These are the part of such asset are not listed as current asset. There is a difficulty of converting it into cash within a short span of time. So the benefit of such asset will be getting after a long period of time. Normally it will be more than 1 year. So that is the situation of a non-current asset, or it is called a fixed asset. In liability situation, liabilities are the obligation to the parties other than owners of the business. So it is an obligation to the parties, it is other than the owners of the business. The obligation of the parties is other than the owners of the business. And liabilities are also classified into current liabilities and long-term liabilities in the balance sheet. And current liabilities are the obligation that are expected to meet within a period of 1 year. There will be a liability, you have to meet the liabilities within a period of 1 year by using current asset of a business or by provision of goods or services. You have to meet the liabilities from current asset or the provision of goods or services. So that is important. All liabilities that are not current liabilities, so that is called a long-term liabilities. Though there are some liabilities which is not current liabilities, so that is called a long-term liabilities. See, there will be there is a format of balance sheet: capital and net profit, add net profit, then interest on capital, then you have to add, then less drawings, less net loss, then non-current liabilities on the liability side and current liabilities on the liability side. And here asset side, fixed asset on top, the different types of fixed assets like building, land, plant, machinery, etc. will be there, and current assets will be on the next part, that is inventories, bills payable, that is prepaid expenses, cash in hand, cash at bank, etc. Then fictitious asset is also there will be in the part of current asset. There is a non-current asset is also there, that is goodwill, patent right, copyright, etc. are also they will be there on the asset side of that particular account. So once you are preparing the balance sheet, both liability side and asset side of the account is equal. And in the final part of this video, we are going to discuss about what is grouping and marshalling of assets and liabilities. So grouping means putting items of a similar nature under one head so as to distinguish them from other items. So this is the process of grouping. For example, in current assets, you are putting all that things, that is cash in hand, cash at bank, stock, debtors, all these things are grouped under the head of current assets. And fixed asset, you are putting all that things like plant and machinery, land and building, furniture, etc. are grouped separately under the head fixed assets. So you are combining or grouping the entire things and put it in a single one, that is called the process of grouping. And in case of marshalling, it refers to the manner or order in which the asset and liabilities shown in the balance sheet. You are showing assets and liabilities in the manner in which the assets or liabilities are showing, that is called marshalling. The arrangements of assets and liabilities in the balance sheet is called the process of marshalling. And there are two ways of arranging things: in the order of liquidity and in the order of permanence. In the order of liquidity and in the order of permanence. So in the order of liquidity, in this method, the assets which are most easily convertible into cash, that is called most liquid asset, that you are written first, and it is followed less liquid asset, and least liquid assets are shown on last. So this is the way you have to present. And liabilities are arranged in order to in the order of urgency of payment. So it is it is based on the payment of urgency. The most urgent payment is the first one, and the least urgent payment or the less urgent from the that is, it is a part of the capital, or it is a part of the owner, like the capital and all, that is the ownership securities and all that things will be there on the last part. So this is the way, the most important asset that is easily converted into cash, that you have to write first, that is the in case of asset, and the least important assets will be there on the last part. In case of liabilities, the urgency of payment liability will be there on the top position, and the least urgent items will be there on the bottom position of the liability side of balance sheet. And the second one, in the order of preeminence, in the order of permanence. So the liabilities are quite reverse the order of liquidity. In the order of permanence, it is the reverse the above liquidity order, and here the method least liquid assets are shown first, followed by comparatively liquid assets, and ending with most liquid assets. So it is first one you are converting the least liquid asset. There is no there are some assets that is called fixed assets will be there on the first position. So after that, that is you are entering the liquid asset, and the most liquid assets will be there on the third position. On liability side, the honest capital and funds are on the first position, and other things, loans and finally the current liabilities are shown on the second and third part of that liability side of balance sheet. So this is the way we have discussed that there is a balance sheet format that we have discussed in this video presentation, and that is prepared on the form of this particular system of presentation. On the order of permanence, we are prepared the statements like the least important liquid assets on top, like fixed asset and all top, then fictitious asset, and there will be current assets. So here ownership securities on top, then other liabilities like bank loan and other things on the next position, and finally the other current liabilities will be shown on the next position. So this is the way we have to present the items in the order of permanence situation. So these are all the things that we are discussing in this video presentation, and here we discuss the concept of accounting and the golden rule of accounting. Then what is asset, liability, the concept of asset, liability, and different types of assets and liabilities. Then different accounts, statements of statement of accounts like income statement and position statement. We discuss the trading account, profit and loss account, and balance sheet. So posting of different items is format. Then after that we have discussed about what is grouping of item and marshalling of item.